In this video, we are going to shed light on a topic that might be unsettling and super confusing for many. It's crucial to address this issue before it spirals out of control. The landscape for banks is rapidly evolving, and it's poised to have a significant impact on all our lives in the coming months. As we step into 2023, a credit crisis is already unfolding, posing a serious threat to the financial stability of countless American families. Loan terms are tightening, while the cost of living continues its relentless ascent. Securing access to credit is about to become a major challenge for U.S. consumers, and experts are drawing parallels to the financial meltdown of 15 years ago. Guys, the recession of 2008 not only pushed millions out of work and wiped out savings, but also triggered one of the most severe credit crunches in history. During that time, many found themselves grappling with insolvency and foreclosure, unable to meet their loan obligations or provide for their families. Between 2013 and 2019, consumer debt remained relatively stable as the economy slowly rebounded. However, the COVID-19 pandemic disrupted this delicate balance, forcing Americans to increasingly rely on credit cards to make ends meet. Today, our debt levels have surged to unprecedented heights, and the risk of a systemic banking crisis is growing. Financial institutions are now taking a cautious approach to lending. Bank loans also play a fundamental role in our ability to purchase homes, cars, fund our children's education, and enjoy the pleasures of today while deferring payment to the future. The essence of the capitalist model has always rested on the extension of credit and the accumulation of debt that follows. For decades, the U.S. consumer culture has thrived on the buy now, pay later philosophy, allowing households to delay immediate expenses while steadily accumulating record levels of debt year after year. Guys, in the current landscape, the combination of persistent inflation and soaring interest rates is stretching consumers' budgets to the limit. Data shows that most households are teetering on the brink. Just last month, American debt levels reached an alarming milestone. For the first time in history, credit card debt has surpassed $1 trillion, according to the Federal Reserve Bank of New York. And in the second quarter alone, credit card balances surged by $45 billion, nearly 5%, reaching a staggering $1.03 trillion. This amount is more than triple the average increase in household debt during the same period in previous years. Post the Great Recession, the Federal Reserve's most recent quarterly report on household debt and credit reveals a significant surge in not only credit card debt, but also auto loans and mortgages, propelling overall household debt to $17.06 trillion. And yes, this marks an almost 15% increase from pre-pandemic levels, translating to an additional $1 trillion of debt accumulated each year for 3 consecutive years. This trend is driven by the cost of living rising 4 times faster than income since 2020. Over the past 2.5 years, households have been spending more while earning less each month. For those earning the median income or less, which represents roughly half the population, turning to credit has become the only means to cover basic expenses. According to Walthup, a personal finance website, from July 2022 to July 2023, total credit card debt surged by 8%, marking 5 consecutive quarters of growth at rates not seen in 2 decades. Guys, unfortunately, the situation is poised to worsen, as pointed out by Matt Schultz, chief credit analyst for LendingTree. The driving forces behind this surge are inflation, high interest rates, and the overall steep cost of living in 2023. Estimates from LendingTree suggest that the average household's credit card debt now stands at $10,170. Eventually, these figures paint a stark picture of financial distress among Americans, As highlighted by Mark Whitner, chief economist with Piedmont Crescent Capital and former senior economist with Wells Fargo Securities. Whitner emphasizes that higher interest rates are further complicating the economic landscape. Up until March 2022, the benchmark U.S. interest rate hovered just above zero. However, the Federal Reserve initiated the most aggressive quantitative tightening cycle on record. Interest rates now range from 5.25% to 5.50%, the highest levels seen in over 2 decades. As these interest rate increases trickle down from the federal funds rate to mortgages and credit cards, they burden everyday consumers, as explained by Sophia Peig, an economist at decision intelligence company Morning Consult. In an interview with CNN, McBride underscores that people aren't taking on debt at 20% interest rates out of financial stability. They're doing so out of financial strain. Many households are stretched to the limit, and any further rate hikes pose an uncertain future. This is particularly concerning given that 55% of cardholders carry a balance from month to month with double-digit interest rates. Credit, once a tool for financial stability, is now threatening to bury consumers deeper in debt. In fact, a recent poll by Redfield and Wilton Strategies found that 74% of Americans are deeply concerned about their ability to pay off their credit card debt this year. On the flip side, some individuals are already exploring alternative strategies to escape debt. But these efforts can strain their finances. Bank of America recently reported an increase in people tapping into their 401k accounts due to financial distress. During the second quarter, the number of individuals making hardship withdrawals surged by 36% compared to the first 3 months of the year. Well, a significant portion of consumers is already apprehensive about accessing credit in the face of rising interest rates and stricter lending standards at banks, as revealed by the New York Fed survey of consumer expectations. The proportion of individuals indicating that securing loans, credit cards, and mortgages has become more difficult compared to a year ago has exceeded 60%. Reaching the highest levels in data tracked since June 2013. Concerns about credit access have steadily risen over the past year, particularly among low-income Americans and small businesses. Conversely, a warning sign for banks is the sharp increase in debt delinquencies in recent months. The number of individuals delaying debt payments has more than doubled since 2019. According to Bankrate, this year, delinquency rates have surged across all types of loans, including credit cards. The number of accounts overdue by one billing cycle has climbed by 42.6% over the past 2 years, with delinquencies now reaching levels not seen since 2017. Nonetheless, escaping debt and maintaining a healthy credit score is arguably more critical now than at any point in recent years. Banks and financial institutions are becoming increasingly stringent in their lending practices. They are rejecting applicants outright, raising minimum credit score requirements, charging higher interest rates, and reducing credit limits. In the wake of the collapse of several major banks earlier this year, financial analysts raised concerns about a looming credit crunch, a situation where consumers and businesses struggle to access the loans they need. Over the second quarter, a significant proportion of banks reported tightening their standards for credit card loans and other consumer loans, as per the Fed report. Data from the U.S. Central Bank provides another perspective, with rejection rates for all types of loans, including credit cards, mortgages, and auto loans, surging to nearly 22% by the end of June. This marks the highest point in 5 years and one of the highest readings since the survey's inception in 2013. Randall Votsek, a financial advisor at Raymond James, highlights a critical aspect of the situation. He points out that due to inflation, soaring interest rates, and mismanagement within the banking system, The industry finds itself with fewer resources at its disposal. When you have less money, you focus on the highest quality individuals you can find with the limited resources you have, he explains. Consequently, banks are now requiring more comprehensive financial information, particularly regarding income, making it especially challenging for gig workers and small business owners to secure loans, given their income often stems from self-employment. Votsek observes a paradoxical situation. Those who need money the most are less likely to get it, while banks are more willing to lend to individuals with impeccable credit histories. According to credit scoring from FICO, a credit score ranging from 670 to 739 is considered good, while an excellent credit score falls between 740 and 799, and an exceptional score surpasses 800. In essence, lenders are becoming increasingly reluctant to engage with individuals whose scores fall below 670, a category that encompasses roughly 35% of the population. Earlier this month, major credit card issuers like Visa and MasterCard announced impending fee hikes, set to take effect in October. Credit has rarely been as expensive as it is now in the 21st century. Therefore, if it's possible to reduce debt and refrain from using credit cards during this ongoing economic downturn, doing so can help prevent falling into a spiral of debt down the line. The ongoing credit crunch threatens to financially strain numerous borrowers burdened with high levels of debt. If you find yourself in such a situation, seeking professional assistance to restore your financial health may be advisable. As we wrap up, it won't be wrong to say that our society has largely overlooked financial education, leaving many individuals ill-equipped to manage their money effectively. And guys, this lack of understanding can lead to financial trouble. And once ensnared, it can take years to regain solid financial footing. The repercussions can affect every facet of one's life. Now is the time to brace ourselves and prepare for the challenging years ahead. Banks are facing danger, the financial system is in turmoil, and the Federal Reserve's ability to bail us out is limited. Unfortunately, this potential for disaster is very real, and the longer we delay addressing these issues, the more significant they become.